Good morning, everyone, and welcome to the BDH Sterling presentation on maximising your Australian superannuation as a UK tax resident. During the session today, we will share information and considerations around how and when to access your Australian super, how your tax residency affects your super decisions, and how to understand the income you'll need in retirement and when you might be able to stop working. Before we begin, let me take you through the general information warning. This information is of a general nature only. It does not take into account your personal objectives, financial situation, or needs. Please do not act based on this information. It may not be suitable to your circumstances. All contents are based on our understanding of legislation in both Australia and the UK as at the 26th of Jan 2026, which is subject to change. To caveat that, the value of your investment can go down as well as up, and you may not get back the full amount you invested. Past performance is not a reliable indicator of future performance. Your pension income could also be affected. Excuse me. Sorry. Your pension income could also be affected by the interest rates at the time you take your benefits. Levels, basis of, and release from taxation may be subject to change, and their value depends on the individual circumstances of the investors. Moving on, I'll introduce you to the pair that will be presenting to you today. My name's Louise Duncan. I'm one of the UK financial planners based in our UK Epsom office. I specialise in retirement income planning, particularly where there's super withdrawal advice involved as well. I'll be helping to facilitate today's session and assisting with the question and answers at the end of the session. If you do have any questions, could you pop them in the Q&A box, and we'll do our best to cover those at the end. Joining me today is Nick Bond. Nick has been with BDH Sterling since almost day dot, I believe. He's dual licensed, has extensive knowledge in both UK and Australia planning, and is also UK pension transfer certified. He brings a depth of knowledge for cross-border planning. And he has the tough job today of taking us through the main content and everything you need to know when it comes to planning for retirement and accessing your super. Today's agenda, we'll be looking at 5 key areas before we talk to you a bit more about BDH Sterling and the Q&A session. So we'll be covering off the Australian super withdrawal regulations, retirement and income planning, pension contribution strategies, reversing the direction, and as well as the value of advice. With that said, I will hand you over to Nick to start our first session or section on Australian super withdrawal regulations. Over to you, Nick.
Thanks, Louise, and welcome everybody, and thanks for joining us today. So on to the first section. What are the rules around withdrawals from Australian super? So the first one is the condition of release. Have you reached the right age to be able to access your super? So the earliest you'll be able to access it is age 60, and you must have ceased employment to be able to access it. Doesn't mean you can't go back to work afterwards, but you have to have ceased employment when you're 60, when you hit age 60, to be able to access that super. If you haven't ceased employment, you will need to wait until age 65 to have full access. But there is an option for transition to retirement at age 60 if you are still in full employment. But we'll cover that off shortly during the presentation. Something to be aware of and a benefit for those that have got Australian super and are drawing it from the UK is foreign service relief. There is tax relief on any super that was accrued up to 2017. So you can access that very tax efficiently. The post 17 accumulation. So if you haven't paid into it since 17, for example, and it's just pure growth since then, or if there are contributions, that is all going to be classed as a taxable component. So you have a tax-free component pre-17 and a taxable component post-17. And you would, if you're drawing from your super fund, if you're drawing down as a lump sum, which is quite typical when we're providing the advice, then you must draw down in proportion from the taxable and non-taxable. You can't just draw from the tax free component. You will be drawing from both proportionately based on what that percentage is from that 2017 period. One thing to be mindful of is the QROPS rule. So some of you may have transferred your UK pension to Australian super when you were living in Australia. If that is the case, then that portion of the money doesn't come under the tax-free component. So anything that was transferred into super will be called up under the QROPS rule. So rules around the withdrawals from super and preservation age. So I did touch on this previously. When can you access your super? So as I said, it's age 60. If you are retired or have ceased employment, and then by meeting the condition of release, you are able to then fully access your super fund. If you're 65 or over and still working, you'll have full access to that super fund money. And if you're 60 to 65 but still working, there is something called transition to retirement that does allow you to get 10% of your fund out from the super fund each year. So that can be quite helpful when one is wanting to wind down work or start to reposition the money back to the UK. We'll touch on this for those of you who may have been watching that were temporary residents of Australia. So if you previously worked in Australia and accumulated super and you were on a temporary visa, or were on a temporary visa, you're able to apply for departing Australia superannuation payment. So it's only applicable to those that were on a temporary visa. It doesn't matter about your age, and it's something you can do via the ATO. But there is tax to be mindful of when you are releasing that under a DASP payment. Okay, retirement and income planning. So when you're considering retirement, it's very important to have thought through and have a good understanding of when you want to retire, but also importantly where. If you're thinking between the two countries, Australia and the UK, there can be significant differences in the tax regimes that may benefit you or not benefit you, depending on which way you're going. What do you want to do in your retirement? Are you going to want to be flying around the world or going on cruises, buying a camper van and traveling? All of this will affect how much income you're going to need, and also start thinking about in the early years, front loading some of those payments might be an option for you. So while you're fit and healthy and can enjoy the money, potentially you can take a bit more in the earlier years and a little bit less in the latter years when you may not be quite as active. So yeah, the answers to these questions and us helping you dive into those questions will really provide the basis of the advice that we will give. Our role is to try and help you meet those objectives and tell you what's viable, what's not viable, and making a slight change to those objectives can often have a big impact, positively or negatively, depending on what you're going to do. For example, working a bit longer might have a really positive impact on your overall retirement plan, or retiring a bit earlier than you ought to can have quite a sometimes negative effect on how much income you're going to have and how long that is going to last you. So the important thing when we're providing the advice is cash flow planning. So we want to analyze your income and your expenditure and understand how you're spending your money, what difference will be in retirement. So some spending may drop off, some may increase. So that is crucial, is the cash flow planning. And then within that, if you've got other UK assets as well as Australian super, we will be able to determine how best to draw down from that Australian super, how tax effectively we can draw it and utilise tax-free thresholds in the UK. So that will map out how the super ought to be drawn down. And then, if you've got any future commitments, helping children with university fees or weddings, or some people want to try and assist a bit if they can with property purchases in the future. Knowing these big expenses in advance is very important because it can be planned for now rather than getting to the pointy end and needing to have access to a big lump sum that hasn't previously been accounted for. And we'll help you and manage those financial priorities and give you a roadmap as to what we think you should be doing to maximise your income and trying to help you limit expenditure where it's unnecessary. So the cash flow forecasting. The slide shows a before and after table, essentially, and it will test how your retirement provisions are faring based on what your objectives are. And it will also test the impact that inflation will have, because inflation will be a moving target, as will investment returns over the years. So it's important to make sure you don't have any of the red, and important for it to be all blue to make sure, come what may, you're going to be able to meet your retirement income needs. So we can run scenarios to determine what advice is required to make sure you can hopefully be in the blue for throughout your retirement. And if you can't, then we'll make recommendations to help you get there. So we've got a case study here. Mr. Smith is a UK resident, age 60 and recently retired. He accumulated 500,000 in an Australian super fund. As he lived and worked in Australia for 30 years, this represents the bulk of his retirement funding. He's considering his options. So remember, there is a double taxation agreement between the UK and Australia. So even though drawing from super is tax-free in Australia, the ATO will not tax it on the way out. The HMRC, because of that double taxation agreement, will have taxing rights for the income that Mr. Smith draws from an Australian super. However, he hopefully, if he meets the criteria, will be able to apply foreign service relief, and some of his fund will therefore hopefully be eligible to be withdrawn tax-free. But Australian super does any growth and any additions post 17 does become a taxable component. And the drawing from your Australian super will add to any other taxable income. So if you have state pension or are due to get state pension in future years, if you're drawing from a UK pension, if you've got rental income from property, all of this is taxable income, and your Australian super withdrawals will be added to that assessable income in the UK. So pension contribution strategies, what are your options for contributing into pension or super? So the two jurisdictions have quite different tax regimes. So in the UK, when you pay money into your pension fund, you get tax relief from the UK government. If you're a basic rate taxpayer, you get 20% at source. If you're a higher rate taxpayer, you can get 40% relief via completing a tax return. So it is very advantageous to pay into a UK pension because you get that tax relief. And the difference between the UK and Australia is, in Australia, there's no tax payable when you're drawing from an Australian super, whereas there is tax payable when you're drawing from a UK pension fund. So if you've maxed out contributions into a UK pension, then you could consider paying into an Australian super fund over and above that. The priority, if you have taxable income in the UK, would be to pay into a UK pension. But if you're considering or strongly considering retiring in Australia, then you can also make further contributions into Australian super as well to, in an ideal world, get as much of your asset base into super or pensions as you possibly can pre-retirement. So the main aim is to maximise your tax efficiency and take advantage of those two different jurisdictions. So in summary, tax relief on the way in from the UK, but taxed on the way out, apart from 25% that you're able to access tax-free up to certain limits. There grows tax-free as well during accumulation and retirement, but tax to be paid on the withdrawal of the remaining 75% if you've taken that 25% lump sum. Superannuation works the opposite way around, taxed on the way in for concessional contributions, but tax-free on the way in for non-concessional contributions. There's tax within the fund in accumulation phase, so realised capital gains, distributions, dividends are taxed within the fund, but on the way out, once you meet preservation age and preservation rules, you're then able to access that money tax-free from an Australian perspective, but as I mentioned before, accessible from HMRC's perspective. So, on to the next slide. There we go. So we always get this question where if people have got multiple assets, you might have ISAs, you might have super, you might have pension, you might have savings in the bank, you might have a share portfolio in your personal name, you might have investment bonds, you may have a number of different assets. So it's important for you to understand where you're going to be drawing that money from. And essentially, we will look at what is the best source to be drawing your money from to minimize the tax. For example, if you've got ISA savings, after you've accessed the 25% tax-free, maybe the ISA is the next place to go to. If you as you can draw down from that tax-free, maybe is the UK pension and drawing down within tax-free thresholds. Maybe that's the superannuation to start drawing some of that out before For example, state pension might kick in. But yeah, if you've got a few different asset bases, they're all going to have different tax treatment, and we can help you to maximize or provide you with a strategy to maximize the withdrawal in the most tax efficient nature. Okay, case study of someone who is going to draw down under transition to retirement. So this is where you're age 60 or in between 60 and 65, and you're still working. You don't meet the condition of full release because you haven't ceased employment. So at age 60 to 65, you can access 10% from your super fund. Which then potentially, and I say potentially because there are things we need to be mindful of, but you can potentially add that 10% withdrawal from the Australian super fund, which some of it will have a taxable component, some will have a tax-free component. But you can take that income and then you could add that into a UK pension if you're still working and you've got a salaried income that you're paying tax on. So to run through the example, Mrs. Jackson is 60, has the equivalent of £150,000 in her Australian super. So therefore, 10% of the balance is £15,000 that she's able to withdraw per annum. She then uses that 10% to make UK pension contributions, making a tax saving. So if she's a basic rate taxpayer, she'd save £1,538. And if she were a higher rate taxpayer, she'd save £3,076. So even though you might pay some tax on the way out from super, potentially you can get some of that tax back by making contributions into a pension. So you get tax relief on that. And then those contributions that you make, you can still get some tax relief on because you'll be able to withdraw 25% of that out tax-free, again, subject to certain limits. So it can be quite a tax-effective strategy to be drawing down on your Australian super whilst you're still working. Okay, on to FIG or foreign income and gains regime. So in the October 24 budget, Labor and Rachel Reeves announced a series of reforms, and they came into play in April 2025. One of those, which is quite an interesting option to explore, is the FIG regime. So you have a 4-year tax-free window when you return to the UK if you've been abroad from the UK for 10 years or more. So your foreign income for that 4-year window can be tax-free. So this can give us an effective strategy to to draw down from super within that 4-year window if you're a recent returning resident to the UK, but you've been outside for over those 10 years. And it does offer good planning opportunities. So you can get money out of Australia, get it repatriated back to the UK, start topping up ISAs or national savings and investments, whatever it may be, and getting that money into a favourable tax environment as possible in the UK. One thing to point out is you do lose your tax-free threshold if you decide to claim the FIG relief. Okay, reversing direction. So things to consider. Australian super cannot be transferred from an Australian super fund to a UK pension. It's just not possible. You can transfer a UK pension to a super, but you can't transfer a super back into a UK pension. If you're in accumulation phase, you need to make sure that your asset allocation is in line with your attitude to risk and your objectives. So you might have a risk tolerance of somewhat of a balanced nature. I'll use that because it's middle of the road, and you need to make sure you're comfortable with what balance means and how that's invested within that super fund. But also, it's important to make sure that that balance profile is going to help you to meet your objectives. The returns that you get within your super or your pension fund can have a significant difference to you retiring earlier or later, depending on how that money's been invested. So it's very important to understand getting the right asset allocation within your super fund and your pension fund to make sure it's going to help you meet your objectives, but you be comfortable with the risk that you're taking. Can you return to Australia and take super as a tax-free lump sum? Yes. You need to move back to Australia, become a resident. You would not then be able to return to the UK for 5 complete UK tax years from taking that withdrawal. So it's not as if you can go back to Australia for 12 months or 6 months, draw the money out, and then hop back on a flight to the UK. There's anti-avoidance rules in place to stop people doing that, and that is a 5-year period of time that you must be outside of the UK if you're withdrawing your super and want to retain its tax-free status. Other considerations. If you're UK domicile, then there will be IHT to think of. So that net has just got a bit tighter in recent times with what Labour have proposed and is due to come in to action fairly soon, and that is including pensions within the IHT net. So it's very important that you understand that and consider the implications that might have for your beneficiaries on them receiving your estate. So it's always good to seek expert tax advice on the optimum residency position. Some people don't understand how easy it can be to be classed as a UK resident if they didn't mean to be. There's a residency test that determines upon different ties that you may have how many days you can spend in the UK without you becoming a tax resident. So something important to consider. Okay. On to the value of advice. So look, it's very important to understand that this is a very difficult and tricky, complex tax position for some people to be in, and getting the right advice and getting a great strategy in line for you to be able to withdraw down from super tax effectively and efficiently, but not only that, but also making sure your overall plan is right for you. And if you are withdrawing money and repatriating money from Australia to the UK, making sure that you've got it in the most tax efficient structures possible. Yes, of course, we charge a fee for our advice, but I'd like to think in almost all circumstances that we can save people a lot more than the fees that they incur by taking advice from us, not only on the super withdrawal, but as I said before, the structuring of the assets when you're back in the UK and you're repatriating often large sums of money into a new tax regime. And not only that, but it's going to give you it's going to give you confidence. It's like a hand-holding exercise to make sure that you're not worrying in future years. Have you got enough money to retire? What age can you afford to retire? that's always the major question, and hard to put a monetary value on that. But if we can put a plan in place for you and determine within reasonable certainty when you're able to afford to retire, that often gives people a lot of comfort, because if you have a bad day, week, month, or year at work, or God forbid you're sick, you can know that you can pack up tools and retire comfortably if you've had that work done and a strategy is in place. Okay, so why BDH Sterling? So we understand the difficulties of moving between countries. Many of our staff have done it. Majority going from the UK to Australia, but the occasional one returning back. So we have first-hand knowledge of that. Not only that, but it's our core part of our business, as well as being financial planners. We're experts on the cross-border transition of people's lives. We are chartered in the UK, and that's the highest designation for financial planners. So it's very important to use a firm that have worked hard on their education and understand UK financial planning. Not only that, but we have dual licensed advisors in both countries, with many years of experience in both sides. The firm BDH Sterling, we've been in operation now for over 16 years. There's a few that have been with BDH since day one, myself almost included. I've nearly been there since day one. So we've got longevity. We've got many members of staff that have been with us for a long time and have a real deep understanding of the complex nature of the business we're in, and are able to really help those individuals that are moving abroad between Australia and the UK. All of our advice is delivered in-house through our Australian office or our UK office. We've got advisors, admin staff, power planning team in all offices, both in the UK and Australia. We've got a good rating on Google and Trustpilot. This is important to look at these things, because it's hard to get it's harder to get good ratings than it is bad. So if you're looking to review a firm, I would personally jump on Google and look for those reviews, and you'll get the good, the bad, and the ugly. And yeah, our reviews on Google and Trustpilot are pretty strong. So yeah, and we're able to provide advice in other financial service areas. As I've mentioned, UK pension transfers to Australia. We have a sister company called BDH Tax, that if your situation is complex and needs further advice, we can refer you and put you in touch with BDH Tax. And of course, retirement planning, broad-based retirement planning, both in the UK and Australia. So if you want to contact us, you can reach out at inquiries@bdhsterling.com. Let us know a bit about your situation if you're emailing in. Good to understand what the inquiry is about, and then you will be able to book in for a free initial meeting. So we have a qualification phone call first, and then if we think we're able to help you, we can book you in for a free initial meeting, either with myself or one of my colleagues, to run through how we think we can help you and what value we think we can add. Okay, on to the Q&A. So Louise, I'll pass it back over to you.
Thanks, Nick. Thanks for taking us through the presentation. We have had a lot of questions come in the Q&A box. Just a reminder that if you do want to ask a question, the best place is the Q&A box. We have a lot to get through, so if we don't get to your question today, we will come back to you via email. And just as a reminder, again, we will be sending out a copy of the slides to those that want it, and it will appear on our YouTube channel. So let's kick off. I think we've got 40 something questions. Some of these may have been answered as we've been working our way through the slides. Let's have a look at the first one. There's quite a few questions around tax residency and tax being withheld, and the 25% tax free. Will they withhold tax in Australia on lump sum withdrawals? If you're in the UK and you're a UK resident, as Nick pointed out, HMRC will hold the taxing rights on that. Some websites say I'll be treated as a foreign resident and not a UK resident. Yeah, look, residency is, I think we touched on it on one of the slides as well. We can certainly help you better understand your residency status because that's quite key as and when you access super and can make an impact to tax. And that's why sometimes it's best to have a chat with us. It's not simply just understanding amount of time you spend in each place. You know, Nick touched on there are what we call residency tests, statutory residency tests. There was another question around the 25% tax-free on my lump sum in the UK. Do I get the 25% tax-free on my lump sum in the UK? I'm not quite sure if that's just alluding to UK pensions. So UK pensions, yes, you still have your 25% tax-free allowance on your UK pensions. If so, is it taken after the tax-free component or amount earned? Right, okay, so I think this may be on the Oz Super. Just to go back over the Foreign Service Relief rules again, essentially value built up in an overseas pension, i.e. super up until 5th of April 2017, if it meets the criteria for Foreign Service Relief, and there is a criteria that we would need to check, that bit essentially is tax-free. Any increase in value from that date until the point of withdrawal is aligned with treatment of a UK pension. So 25% is tax-free and the balance is taxable at your marginal rate. So first we would establish those values, but we would have to look at if you meet the criteria under Foreign Service Relief rules. And then we would look at there's different methods we can use to calculate those values. So of course we'll always go down the route which offers you the most beneficial outcome. So yeah, you do get essentially some of your 25% tax-free on the post 2017 growth, but you have to draw proportionately across the pre and post at 2017. I will be 60 in February and will stop working for myself. Can I take it in 2 times 50% lump sums, one in February and one in April to get it into the next tax year? And that's part of the work Nick mentioned. You know, we look at your income and expenditure and your, cash flow planning. And quite often we can come up with a strategy to make it as tax efficient as possible. And it may be that we take a larger lump sum in the first side of the tax year and then straddle the new tax year to get another lump sum out, depending on what your taxable income has been. And that's when we can often piggyback making recommendations for UK pension contributions to help offset tax. But yes, you could effectively do a withdrawal in the current tax year and another one in the new tax year, straddling tax years. What you need to be mindful of is every time you make a withdrawal, because it's apportioned between the pre and post April 2017, when you make that first withdrawal, we do recalculate how much of Foreign Service Relief is still available. And of course, that's based on the value on the day of withdrawal and the exchange rate as well. I'm both an Australian and British citizen. I've lived and worked in the UK since 2008. What are the mechanisms for tax arrangements when I access my fund next year when I'm 65? So you do have to declare any super withdrawals on your tax return, even if you're making use of the foreign income and gains regime. We will help you to tell you whereabouts you need to declare this, when you need to declare it, and give you appropriate wording on how to declare that on your tax return. You'd have to complete a self-assessment tax return. What are the tax rates pre and post 2017 Foreign Service Relief? Good question. Tax rates are so pre 2017 is not taxable. Post 2017, after you've allowed for your 25% tax-free cash, it's taxable at your marginal rate. And that's why we would always look at what taxable income you have in that year that we're making a withdrawal. And that's why it's quite key sometimes to better understand what age you want to retire, what other assets you have in the UK to support that, that we can possibly defer putting off or accessing whilst using a super to get that back here in the UK. And there's an opportunity as well before, state pension kicks in. So just as a reminder, when you do make a withdrawal, you can't elect to say, well, I'll take all the pre-2017 value out because that's tax free. Any withdrawal is apportioned across the pre and post pot. I have super all prior to 2017. Does that mean all my super is tax free? It's a great question, and it isn't. So essentially, the fund value acquired up until 5th of April 2017. We'll take a snapshot at that date. There's different methods we can use to calculate that. That bit is the bit that's tax-free. It's the increase in value from the 6th of April 2017 to the date of withdrawal that would be subject to tax. Another good question was that if you had your own supervaluation from that point, is it something I can do myself, and why do I need an advisor to help me? It is a minefield. We've focused a lot on the value as at 2017. However, there is a strict criteria that the super needs to meet in order to qualify for foreign service relief. Foreign service relief is only available on lump sum withdrawals as well, instead of, regular income streams. But it's more to do around, and I think Nick touched on it, what was your visa status at the point of accumulation? Have you transferred any UK tax relieved funds into your super, as they need to be treated slightly differently? So yes, it can help you determine or get an idea of what you think may be applicable for foreign service relief, but it's whether or not you meet the criteria. How do you fill out your tax return? So HMRC, no, you have the foreign service relief. There is a section within the self-assessment tax return that covers this off. And we would give you the figures when we do your calculations that you can include, along with the dates that you need to submit your tax return, and some wording that we recommend you use when submitting your tax return. How do you start the transition to retirement?
Do you want me to do that one, Luke?
Yes, please. Yeah.
Yeah, okay. So as long as you're at age 60, you will be able to begin that process. You need to speak to your superannuation scheme and explain to them you want to begin drawing on it under transition to retirement. Whatever the value was at the July 1st in the year that you've turned 60, that's your valuation point, and you can draw down 10% of the fund under that. So in summary, it's simple. You need to contact the super fund, and they will guide you from there.
Thanks, Nick. When I asked about my Oz super fund about withdrawing my super, they said I would have to pay a Medicare levy for the time I've not lived in Oz. Nick, any insight? It's not one that I've come across before.
No, I don't. I don't see why that would be the case. I would ask again, and ask them to point you to the legislation where it points that out, because doesn't seem right to me. Look, it depends who you get when you're on the phone to some of these super funds. So I would make another call, and
Mm,
if they say it is, ask them to point to where the legislation states that.
thanks. How does paying into Oz Super affect tax status? I'm currently a UK taxpayer. I think this is kind of goes back to the slide that Nick talked through about the benefits of paying into a UK pension when you're a UK resident, the tax benefits and the tax savings that can be made here rather than in Australia. Happy to provide more information on that offline if you want to have a chat through, but there are definitely benefits to if you're a UK tax resident, UK taxpayer, contributing to a UK pension, benefiting from the tax relief that you receive and building up your assets, particularly if you're going to be in the UK permanently, to support your retirement income plans. Does anyone happen to know at what point can withdraw funds without being taxed in the UK, assuming no longer resident? I think I read max 16 days if resident in the past 3 years, or else 46 days. Again, Nick, did you want to jump on the tax residence question?
Yeah, so how many days you can spend in the UK is determined by the number of ties you have. There is a test, a statutory residency test, that will determine that. So you could Google that quite simply, statutory residency test UK, and you should be able to determine how many of those ties are applicable to yourself. And then that will determine the amount of days that you can spend in the UK without becoming a UK tax resident. So for some people, it might be 16 or so. For some people, it might be 90. It might be 120 for others. So it is very much based on your own personal circumstances.
Okay. Thanks, Nick. Is it necessary to have an Australian bank account in order to withdraw super? If so, how is it possible to set up an Oz bank account when I live permanently in the UK? It's a great question, and one that we've kind of seen a real change with super requirements. A lot of the supers will want you to have an Australian bank account, but appreciate, coming back to the UK or being in the UK, not everybody has access to that. So there is a workaround that supers will allow where you can open an account with certain institutions like Wise, for example, that they will pay into. They need to just ensure that you can have a BSB number as well. And I think there was a question around an Oz phone number as well. There were issues in the past. Supers have upped their game, I have to say, and recognise that, it's not always possible to have an Oz phone number. BDH do all the liaison with your super when we're working on your behalf. We will arrange for the paperwork, we will liaise with super, we'll submit it, and all the ID requirements are met as well, just to try and make it as easy and as seamless as possible for you. What are the criteria to meet foreign service relief? There's quite a lot of criteria that need to meet foreign service relief. So I'm not going to bore you with accountancy legislation or pensions legislation, but yeah, it's part of the research that we do when looking at your super. We do ask a lot of questions and have to do quite a lot of checks around that. But essentially, it's not just like I mentioned, checking what that April 2017 value is. I'm 63 and have no intention of ever retiring. Does that mean I cannot access my Australian super? Absolutely not. You've got, if you're still employed, You can still make withdrawals using the transition to retirement rules between 60 and age 65. So you can still take your 10% up to 10%. At 65, if you're still working and still employed, you can then make a full withdrawal from your super at that point if you wanted to. Would it make a difference if I were to keep some of my super payment in a bank account in Oz to spend when I visit? No, great question. And quite often, when we talk to our clients, there is the intention when they do go traveling back to leave some of their funds in their Oz bank account just to help out with spending. Does FIG apply to non-super assets, i.e. savings in Australia bank account? Yeah, so it's not just super, it's foreign income and gains. It's essentially, if you like, on other assets as well. Um, I think we have some information that we've previously shared on our LinkedIn post around the rules. So feel free to have a look on some of our LinkedIn posts, or if you're not sure, pop an email over to the team. Copied from chat. Nick, do you want to take this one? Why is the super drawdown limited to 10% per year if you're a non-resident in Australia?
It's not. If you want, it's only limited to 10% when you're in transition to retirement, i.e., age 60 to 65 and haven't ceased employment. So that's the only time it's restricted to 10%. If you're 65 or above and still working, you have access to the entire fund. If you're 60 and have ceased employment, you'll have access to the entire fund. So it's only when you're in that transition to retirement phase that you're only able to draw 10% per annum.
Okay. Thanks, Nick. Another question. If UK now, retired, age 16, no contributions to Oz since 2011, is there no tax relief when withdrawing the Oz Super to the UK? I ask because you pay 15% tax on the way into the super and 15% tax on any growth. Doesn't seem fair. Andy, you would, again, we'd have a look at the foreign service relief. So you're fully entitled to claim foreign service relief if it meets the criteria. And again, we would look at the increase in value from that date. And provided it meets the criteria, you'll still have the same opportunity of 25% tax free, and the rest is taxable at your marginal rate. Does foreign income tax relief apply from 2017 onwards, even if you have been resident in the UK prior to that for some time? Oz living in the UK. Again, this is when we need to check around where you were, what your residency status was whilst in accumulation, and the type of super that it was. So it's not a straightforward answer, and it's one that we would carry out checks on, A, to confirm you meet criteria, and then yes, to provide you with the calculations. I have a large CGT bill to pay after sale of investment property. Can I use my super balance to pay some of it off? Yeah, so, some people do that. They'll access their super. It's part of their planning strategy when we start looking at cash flow planning, that they may have a mortgage that needs to be repaid, or and the super's kind of there in the background to help to pay that off. So ultimately, yes, you could use funds from your super, but if you're paying a CGT capital gains tax bill, you still want to be tax efficient in any withdrawals. So it's still a worthwhile exercise, and having a look at how much that would impact potentially your long-term retirement income to pay the CGT bill, and if you would be better placed using other assets. Is it possible to make an in-person appointment with you, and how much would it cost? We do face-to-face appointments. We have offices in the UK, if you're UK based in Epsom. And our clients do like to come in and see us, and we enjoy seeing them as well. We charge flat fees. An initial consultation we don't charge for, which is why we suggest perhaps initially having a telephone or Teams call just to see if we're the right fit and if we can help. And at that point, we can discuss fees, services, and all that takes. For foreign service relief, does this mean pre-2017 contributions can be brought to the UK tax-free? No, as I said, you can't simply elect to take out the pre-2017 value. It's apportioned across both sides of the pot.
Do you want me to take the next one?
Yes, please, Nick.
So, can we travel back to Oz for a full tax year, no UK return, live in Oz as a tax resident for a full year, draw down super tax free, then return to the UK and pay HMRC zero tax? No, no UK tax benefit was ever applied to the super account, so I believe TNR doesn't apply. No, if you move to Australia and draw down your super and then return to the UK within that 5 year anti-avoidance period, then HMRC will tax you on that super withdrawal.
Thanks, Nick. Understand the 10% per year once 60. You mentioned adding it to your UK pension, but you can't transfer your Oz Super. Yeah, absolutely spot on. So in terms of the mechanics, you would withdraw funds from your super, and that would be paid into Australian bank account. You bring the funds back to the UK, and from your own personal bank account, you can then make a UK pension. So it's not a pension transfer at all. It's simply treated as a personal contribution to a UK pension. If we've already paid tax on income in Australia and tax on the way into super funds in Australia, why are we being taxed on that again in the UK? If so, can we not just leave those funds in Australia invested in super funds and access the returns via a bank card for day-to-day usage? Great question. Yeah, it is a great question. Unfortunately, no, you can't access super with a bank card for day-to-day usage. And yeah, the rules were there as at 2017 so that, UK tax residents could benefit from having worked overseas and having built up funds towards their retirement. And then, yes, the rule change from 2017 so that they're aligned with UK pensions. Overseas pensions are aligned with UK pensions, 25% tax free, and the balance is taxed at your marginal rate. Unfortunately, yes, there's, in the UK, we have different treatment to our UK pensions. You get the tax relief going in, the funds grow in a tax efficient environment. But when you take them out, there's some tax to pay. Oz is the reverse of that, so it's just different taxation systems.
Do you want to do the next one, Lou?
Yes, please.
What is your fee structure? So we do charge fixed fees for the work that we do, but it is going to be very dependent on the nature of the work. So what I would suggest is booking or emailing us with details of what your situation is. Just a brief summary with values of super funds or pensions, and then we can have a brief call to determine whether or not you're going to be a good fit and whether or not you're going to get value from using our service. And then we can go through the fee structure then. And then if it looks like it's going to work for you, we can book you in for a full 1 hour meeting to really dive into what the situation is and how we can provide value for you.
Thanks, Nick. Is money withdrawn from super and transferred to discretionary trust in Australia liable for UK tax? Assume, but is it protected from IHT? Without knowing the mechanics of the trust or how it's been established or whether the trust would be recognised in the UK, I can't comment. We'd need to know a bit more detail, but it's important to bear in mind that, there has been a rule to inheritance tax rules here in the UK where it used to be domicile based, it's now residency based, so you could be caught up in those. In terms of the actual trust, we're not trust specialists, certainly for Australia. But in the UK, of course, if you were to set up a discretionary trust, we would have a look at if that excludes it from your estate and any pros and cons to putting money into trust. that is a separate piece of work. Inheritance tax planning can be quite intricate. Um, so I would suggest you do seek, actual advice on your circumstances. If inheritance tax is an issue and a driver of that, there are other ways that you can plan for that without necessarily the use of trusts, which sometimes can be costly, need to be registered and have reporting requirements as well. But we do inheritance tax planning as part of our holistic advice.
Okay, do you want me to do the next one?
Yes, please.
Okay, I'm 70, still work part-time and do not touch my Australian super. Can I withdraw and give the cash to family in Australia tax-free, i.e. not take as income in the UK? No, unfortunately you can't. Simply the act of withdrawing it is what triggers the potential tax liability. So even if the proceeds never touch UK shores, and if you're living in the UK and resident in the UK, drawing down from super, that is the trigger for the taxation. So no, sorry, you can't.
Okay. I think we covered off the next one about what officially needs to happen to start drawing the 10%. Can you explain the tax-free on foreign income for 4 years? So, as I said, there's some on our LinkedIn page, there is some further information on the foreign income and gains, the 4 years after returning to the UK after 30 years in Australia. So, yeah, you need to have been non-tax resident essentially for 10 years when you return to the UK, and then you've got this 4 year window from the date you arrive in the UK. So, if you've already been back 2 years, you've only got 2 years kind of left to make use of that. Um, You mentioned you can draw down on your Australian super in the UK and stop working at 60, but can start working again later. Is there a time you need to be not working for, i.e., a year not working? Nick, do you want to take that one?
Yep, yep. No, there's no prescribed time. It's simply that you cease employment from age 60, or it can be before that, but that you've ceased employment and you've reached age 60, you can go back to work in theory the next day after you've started drawing the pension from the super fund.
Great, thank you. Does this mean I don't have to do a self-assessment tax return for the first years after returning to the UK? If you are, I'm assuming you're referring to the foreign income and gains rules. Yes, you would need to, if you're making use of those rules, to declare it, just to make sure that you're reporting it and you're claiming the foreign income and gains and don't end up receiving a letter from HMRC. Is it fee for service for retirement? Can I keep it? Yes, absolutely. We work quite closely with accountants. Um, so, we do holistic planning. When we start to look at retirement income planning, we will do a full analysis of all your assets, not just your Australian super. We will look at, all your UK pensions, ISAs, cash that you have as well when we start to kind of plan that out. And it is a flat fee that we charge for that and put in a plan together. And yet we will quite often work alongside accountants and share information with them as well. Another question around bank accounts. So yeah, most of them, just to reiterate, would want to pay to an Australian bank account. One of the questions we are then asked is about getting the funds back over to the UK. Typically, we would recommend the use of a currency broker when we're talking, significant sums as well. BDH tax, BDH Sterling have, relationships with currency brokers because we are moving a lot of funds back and forth. So if we were to go down that route and work with you, we do get an uplifted rate from some of our currency brokers. So we do encourage you to use those, but also to shop around as well, just to see, who's offering rates at the time. I qualify for Australian pension in November. Have not worked in the UK. Does Australia pay pension if I move to UK? Nick, would that
think
be the Centrelink pension?
yeah, I think that's yeah, that's what the person means. I qualify for Australian pension. I've not worked in the UK. Does Australia pay pension if I move to the UK? I think there is, this isn't my area of expertise, but I think there is some reciprocal arrangement between Australia and the UK for you to be able to get something from it. You wouldn't, I don't think you get the full entitlement that you would if you were in Australia getting Centrelink. But as I understand it, there is a reciprocal arrangement for you to be able to get some. Um, but that's can we could look into that potentially from our Australian end. But yeah, I can't answer that right now. Sorry, that's the best I
No.
can do.
Thanks, Nick. My super didn't allow part withdrawal whole only. Is the equal for the foreign service relief? I'm not sure that if you've been told correct information there, I would go back and double check that. So if you did want to make a lump sum withdrawal, that's what you need to make clear that you're wanting to make a lump sum withdrawal. But of course, provided you meet conditions of release, I would urge you to query that with your super. Are you saying HMRC 25% tax-free applies to drawdown from Oz Super while UK tax resident? I understood the opposite. Just to clarify, foreign service relief is only applicable on lump sum withdrawals. If you started to take regular income withdrawals, it's treated as taxable income, so you don't benefit from the 25% tax-free element. The 25% tax-free bit is applicable as it is with a UK pension to increase in value from 2017 onwards. If Australian citizen and only UK tax resident for cumulative 6 years over previous 20 years, then is that all foreign? So, no, again, we'd need to check how you acquired funds in super up until 2017, type of super, if it meets criteria, before we could make that comment.
I think we've probably only got time for another couple.
Yeah.
Uh,
Do you want to scroll through, Nick, and see if there's any that we
yeah.
haven't covered off?
Is there a similar statutory residency test for Australia, or is it more black and white? They've talked about bringing it in, something similar about 5 or 6 years ago, but it never got through. Never got through Senate. So it is somewhat more black and white. If you're 183 days in Australia, then you would be a resident there. But it does come down to where your home is, your abode. You could do less than 183 days, and you have your home in Australia if you haven't got a home anywhere else, and you'd be classed as a resident. So it is a bit clearer, but you could easily become an Australian resident and not having spent 183 days in the country.
Lovely. Thank you. There's a question around, do we do one-off advice just on super? Yes, we do. We do standalone advice. If you just wanted us to look at your superannuation and make a recommendation on a tax efficient strategy. We have got a lot of questions. As I said, what we will do for those that we haven't been able to answer live today, we will, if you've popped your name in the box as well, we will come back to you on email. We don't want anyone to feel that we've not answered your questions as well as we've had a lot to go through. Nick, anything to add there before I wrap up the session?
No, just thanks for everyone's time and all the questions. It's really good to have that interaction, and it's nice to see people are watching it and have plenty of queries. But we're here to help, and please do contact us if you want further information and you feel you need advice.
We'll be sending out a recording over the next 48 hours anyway. If there are any specific questions, feel free, do get in touch. And we'll have one of the team come back to you. Just as a reminder, initial chat with us, there's no charge for that. Feel free to have a chat to see if we're a good fit or if we can help you. If not, we will point you in the right direction there as well. We will be asking for your help in making improvements to the presentation. If you wouldn't mind completing our feedback survey, it's just 4 questions that we'll be sending out at the end of the session, and it comes along in the email when we send out the slides. So any feedback, much appreciated. Have a look at our website. There's some further guidance on there as well. But yes, thank you for your time. We hope you found it useful, and hopefully we can work and support you in the future with your retirement. Thanks a lot.